The learning objective 4 under CVP analysis is that understand how the income taxes affect the CVP analysis. You must have remembered that last time in the previous example we ignored the presence of income tax. So, now we are adding one more element here, that is the element of income tax. So, for that we can take an example. The management would like to earn an after tax income of rupees 35,711 and tax rate is 30%. Fine. What is the target operating income? So, this I need to calculate. So, target operating income I can calculate by using this formula, that target net income divided by 1 minus tax rate. So, my target net income is rupees 35,711 divided by 1 minus the tax rate is 30%. So, it is coming to 51,016. Okay. So, how many units must be sold? So, revenue minus variable cost minus fixed cost is equal to target net income divided by 1 minus tax rate. So, I can calculate the number of, so I can put the values in the equation itself, the equation which we discussed previously, that is 70Q, this is my total revenue, and 42Q, INR 42Q, this is my variable cost, 84,000 is my fixed cost and my target income is 35,711 and 1 minus tax rate is 30%. So, 1 minus 30% is 0.7, 70%, right. So, if I solve this, I get this equation, INR 28Q is equal to rupees 51,016 plus 84,000. So, Q is 35,016 divided by rupees 28. So, 4,822 units of toy. So, if I include income tax and if the tax rate is 30%, then how many toys I need to get sold? 4,822 toys. Okay. So, I can see here, I can do it, I can see the proof, right. I can directly, if I calculate, it looks like this, that is revenue is 4822 into 70 rupees, 70 rupees is the selling price per unit. So, it comes to rupees 3,37,540 minus variable cost, right, minus variable cost 4,822 units into 42 rupees. So, it is coming to 2,02,524. So, my contribution margin is 1,35,016, right, and fixed cost we already have taken as previous example 84,000 and operating income it is coming to 51,016 and income tax is 30% on operating income, you can see 30% on operating income, it comes to 15,305. So, my net income is 35,711. Okay, fine. So, the other way also I am getting the same result, right. In both the ways my result is same. Okay. Now, learning objective 5, explain CVP analysis in decision making and sensitivity analysis helps managers and how sensitivity analysis helps managers cope with uncertainty. So, learning objective 5 is explain CVP analysis in decision making and how sensitivity analysis helps managers cope with uncertainty. This is very important because ultimately why we are doing this exercise, right. The reason behind, the main motivation behind doing this exercise is it should help in decision making to the managers, right. So, we will see that how it can help. So, we are taking one example again, right. Suppose the management anticipates selling 3,200 units of toy. So, management is considering an advertising campaign that would cost 10,000. Okay. So, it is anticipating selling 3,000 units of toy and it is considering an advertising expense, campaign, it wants to run an advertising campaign that would cost 10,000 and it anticipates that if the advertising campaign is being done, then the sales will increase to 4,000 units. Now, should the business advertise? Should the business advertise? Right? So, this is a decision making problem. Okay? So, I can calculate it like this. So, 3,200 units toys are sold with no advertisement. If I won't do any advertisement, then I can sell 3,200 units, right? It is given here in the problem, right? So, what is the contribution I am going to get? That is 89,600 contribution minus fixed cost is 84,000. So, I am making an operating income of say 5,600, right? So, if I sell 4,000 units, right, with advertisement, my contribution margin will increase. My contribution margin will increase to 1,12,000, but at the same time, advertising is a fixed cost, right. So, if I give a say print advertisement in newspaper or a television advertisement or in radio, so that cost, whether I am being able to sell 10 units or 100 units or 1000 units, right, it will remain same, right, the advertising cost. So, it is a part of fixed cost. Now, the fixed cost, it was earlier 84,000. Now, after if I go for advertising, it is becoming 94,000. So, sales is increasing, fixed cost is also increasing. My operating income is increasing by 18,000, right. Earlier my operating income was 5,600. So, instead of advertising, management is considering reducing the selling price to rupees 61 per unit of toy. Now, management is just exploring the options. One option is it can go for extra advertisement, keep the selling price at same level, right, and then making more sales and in that way making more profit. The second option is because the demand management anticipates that the demand is price elastic. That means, if I change the price, my demand will also change. So, another option which management is thinking of, right, that is, why not we reduce the selling price to 61, right, why not we reduce it to 61 and then see if the sales increases and profitability increases rather than spending the money on advertising. So, it is anticipating that if it reduces the selling price to 61, the original price was 70 if you remember, 61, then the demand will increase to 4,500 units, right. So, if it happens, then should management decrease the selling price per unit of toy to 61? This is the question. Should management decrease the selling price per unit of toy to 61? So, this is the question, right. So, management needs to take a decision. So, 3,200 units of toy sold with no change in the selling price, operating income 5,600, 4,500 units of toy sold at reduced price. So, contribution margin will be now how much? Contribution margin will decrease now, right, because sales minus variable cost is contribution. Because the company is reducing the selling price, the contribution margin will now decrease. So, total contribution margin will also decrease, right, but fixed cost will not change. If you observe here is in this case it is no change, right, and my operating income getting reduced, it is becoming 1,500. Okay. Now, assume that the toy shop can sell 4,000 units of toy, fixed cost same 84,000, contribution margin ratio is 40%. This is the contribution margin ratio. So, at the present time, the business cannot handle more than 3,500 units of toy. To satisfy a demand of 4,000 units, the manager must acquire additional space for rupees 6,000. Now, you see, when these decisions are taken, along with the decisions are not taken in silo. When the company takes a decision, it can impact lot of other things, right? It can affect the supply chain, the production capacity, the market demand. So, all that there may be branding issues are there, some issues are quantitative, some issues are qualitative also, right. So, when the management decides the target level of sales, it considers all these factors, both quantitative as well as qualitative factors. So, to satisfy a demand for 4,000 units, the management need, so this is another factor. So, if it increases to 4,000 units, additional space for INR 6,000. Should the additional space be acquired? So, this is another decision. First decision, we have seen what, that whether to go for add or whether to go for reduction of selling price. So, we have seen that if they go for add, then the operating income is increasing, contribution is increasing. If they go for reduction in price, the contribution is decreasing, but demand is not increasing at that pace. So, overall profitability is falling. Now, the question is, third is, can they, so if when the demand will increase, if they go for add or some other props, if the demand increases, right, if the demand increases, do the company have the adequate production capacity? Now, it is saying that additional space is required. This additional space has additional cost. So, should the company go for additional space, right? So, revenue at break-even point. So, revenue and break-even point we have calculated. This is fixed cost by contribution margin. If you remember, we discussed fixed cost divided by contribution margin. So, 2,10,000, right? This is the break-even revenue. What is break-even revenue? Where the company reaches at a no profit and no loss zone, right? Its profit is 0, loss is also 0, okay. So, revenues at break even with additional space rate, it will now, what will happen, the fixed cost. So, this additional space, suppose if the rental is paid, the rental is a fixed nature of cost, right. So, earlier the fixed cost was 84, now the fixed cost will be 90,000. So, fixed cost will increase. Why it is fixed cost? Because this rental is not linked to the production level, right. After taking the additional space, the company has to pay the lease rent, right. Whether it uses that space, whether it produces extra or not, that is immaterial, right. So, it is a fixed cost. So, what is the new fixed cost? 90,000, and the contribution margin we calculated, that is 0.4. This contribution margin, it is not changing. Why it is not changing? Because I am not changing selling price, right, and my other variable costs also are not changing. I am assuming that that will remain same, right, in a given time period, okay. So, now my revenue, how much revenue is required? It is 2,25,000, right. So, this is my break even revenue, right. So, my earlier break even revenue is 2,10,000, my new break even revenue is 2,25,000, okay. Now, so operating income at 2,45,000 units with existing space, right, is what? 2,45,000 into contribution margin minus 84,000, that is 14,000, right, and 3,500 units I can calculate, the older one, right, I can calculate it is rupees 14,000. Now, at 2,80,000 with additional space, if I go for additional space, then my this fixed cost is increasing, you see, and my profitability is how much? It is 22,000, right. I can calculate other way, 4,000 units of toy into 28 contribution. Contribution, you see, it remains same because sales price and all are is remain unchanged, variable cost per unit remains unchanged. What is changing is the sales volume, right. So, sales volume is now 4,000 units. So, my sales volume is now 4,000 units and my fixed cost, it has increased from 84,000 to 90,000. So, how much I am making? I am making 22,000. Fine. So, in this way I can use the CVP analysis. I can use the CVP analysis for decision making purposes. It is very helpful for making the decisions. Use CVP analysis to plan fixed and variable costs. This is learning objective 6. So, let us go through one example. Suppose that the factory, the toy shop is using to obtain the merchandise offers the following: decrease the price they charge from INR 32 to INR 25 and charge an annual administrative fee of rupees 30,000. What is the new contribution margin? So, INR 70 original selling price, INR 70, INR 25 plus 10, so INR 35. So, contribution margin is increasing now. Earlier the contribution margin, you should remember, it was 28, now it is increasing to INR 35, right. What is the contribution margin percentage? So, 35 divided by 70, 70 is the selling price, so 50%. So, earlier it was 40%, so now it is increasing to 50%. What are the new fixed costs? So, but at the same time, as the contribution margin is increasing, your fixed cost is also increasing. Your fixed cost was 84,000 earlier, now it is plus 30,000. So, your fixed cost is increasing. Now, if you remember, one thing I would like to mention here, if you remember, what is the formula for break even point? Break even point is, I can write like this: BEP is equal to fixed cost divided by contribution per unit, right. So, if the fixed cost increases, break even point also increases, right. And if the contribution per unit increases, so I am writing it, if the contribution per unit increases, then the break even point falls and vice versa. Okay. So, this is the relation. Now, in this case you see the contribution margin is increasing, the fixed cost is also increasing. So, let us see. So, management questions: what sales volume would yield an identical operating income regardless of the arrangement? So, 28x minus 84 is equal to 35x minus, so you see, regardless of the arrangement, right, it wants an identical operating income. So, these two equations should match. This is the older equation, this is the new equation, fine, right. So, if we equate, the x is, if I equate, the x is coming to 4286 units. By solving this equation, I am getting 4286 units. So, in 4286 units, the regardless of the arrangement, it will be identical, you know, the operating income will be identical. So, cost with existing arrangement is equal to cost with new arrangement. Now, if the production increases, if you remember, we discussed earlier that when the production increases, the fixed cost per unit falls, right. That is called economies of scale. So, if the total fixed cost is on the higher side and if your production is high, right, then the per unit production cost, fixed cost, per unit fixed cost comes down. Okay. So, in this case, that means if my production moves to the higher side, the cost structure where the fixed cost weightage is high, that will be more beneficial, right. And if my production level is low, then it is better for me to keep the fixed cost as lower level and large part of cost keep it as variable. Fine. So, you see here, so cost with existing arrangement is this 0.6x plus 84,000. What is this 0.6x? This is the variable cost, this is the fixed cost, old, because contribution margin is 40, sales price minus variable cost is 40%. So, what is my variable cost? 60% of course. So, this is my old VC plus old fixed cost is equal to new VC, new variable cost and new fixed cost. Okay. So, I can solve this. If I solve this, I get the value of x as rupees 3 lakh. Okay. So, if my sales is 3 lakh, then my cost in both existing arrangement and old arrangement, it remains same, right, and it will profitability at the operating income is how much? 3 lakh into 3 lakh into contribution margin, that is 0.4 minus the FC sorry minus the fixed cost. So, I am getting the operating income. And if I follow the new arrangement, you see 3 lakh into 0.5, which is the new contribution margin, minus the new fixed cost 1,14,000, my it is same, right. The operating income is same in both the cases, that is 36,000.